Hi, I'm Eric Jacobson with Morningstar. I'm here today at the Morningstar conference with Bill Eigen of JPMorgan Strategic Income Opportunities. Bill, thanks so much for joining us today.
Oh, no problem at all. Glad to be here.
Good. So you run, as I said, JPMorgan Strategic Income Opportunities.
Yep.
We classify it as a non-traditional bond fund,
Right.
but essentially it's an unconstrained and absolute return strategy.
Yep.
So you have a bias at this point in terms of valuations. Why don't you tell us what that's about and how it looks in your portfolio?
Yeah, well, as an absolute return manager, first and foremost, you have to move with the opportunity set. So right now we're at a point in the cycle where the tailwinds in traditional fixed income are now becoming headwinds. You've got the Federal Reserve exiting. You've got the economy actually growing above trend, which is every fixed income investor's worst nightmare, right? It's good for equities, bad for fixed income. And you do have some inflation pressure starting to show up in the system, and yet you look at rates, not only in the US, but globally, and they're still very, very close to the all-time lowest they've ever been. And most importantly, other areas of the market that typically offer yield premiums are now converging. In other words, you have risk premiums in areas of the market like high yield, mortgage-backed securities, investment-grade corporates, emerging market debt, very, very close to the all-time lowest they've ever been. The problem that creates, as you can imagine, is when spreads get tighter and tighter and rates get lower and lower, correlations pick up, which means you need a very small backup in interest rates to create a lot of losses, as people learned last May and June, when just an innocent remark from a Federal Reserve official caused yields at the 10-year point to double, right? It wasn't even the economy or inflation then. So, I kind of view the rate markets and increasingly other risk markets within fixed income more like a compressed spring. The longer it stays here, the less it'll take to cause valuations to just normalize, right? Not just be at these very, very tight levels. And as a result, more recently, just over the past few months, I've gotten my portfolio much, much more defensive. I'm leaning more on short positions and what we call alpha-oriented positions, which is targeting mainly relative value trades, and also targeting higher rates down the road from here and doing it very gradually as rates continue to fall. We continue to add to those types of positions while selling down our beta positions, which have been very beneficial to us for the last few years. We don't want to overstay our welcome. And the time to sell things is when the markets are incredibly liquid, because we know how fast that can turn when volatility hits.
Mm-hmm. So those beta positions you're talking about were primarily high yield to a large degree.
Yep.
And so can you give us a little more color on what are inside some of those, I guess, alpha or relative value positions as well?
Yeah, like for instance, right now, by default, when long positions get very expensive, short positions get very cheap to put on. So what we've tried to do in our alpha sleeve is target a combination of things. One is idiosyncratic trades. I like to classify my portfolio as a little bit uncomfortably idiosyncratic right now, because those are a lot of the trades we're targeting. But that's what you have to do when systematically risk isn't being priced correctly. So, we're finding one-off trades, and like for instance, individual credit default swaps that react in a non-linear fashion to things like earnings reports, and we can find trades to do there. We have a number of relative value trades targeting mispriced relationships within the credit default swap market, which is a real specialty of ours. We tend to trade a lot of synthetics because when risk either goes on or comes off, it tends to manifest itself incorrectly in those markets as opposed to the cash bond markets. And the other thing we're doing is we're targeting trades that can really benefit from a Federal Reserve really just basically doing what they tell you they're going to do, which is they're going to be completely done with QE by September. It's already down to $35 billion. It's going to be zero by the time we get to September. And also within 6 to 9 months after that, starting to tighten, assuming the economy continues on this very reasonable trajectory, which it's on right now. So we're just taking the Fed at their word. If you believe that, then there are certain types of trades available in the marketplace, including targeting Fed funds and things like Eurodollars, that are not priced for that at all. So you can put on, like for instance, a Fed funds flattener, between 2 and 5 years, and if the Fed does indeed do what they say they're going to do, that trade can create quite a nice return for you.
So among the things that you're not holding much of right now or at all, but that you imagine might look a lot better on the other side of some volatility, are there specific sectors or areas that you really have your eye on that you think those are where I want to go?
Yes, absolutely. And you're exactly right when you say we are holding a lot of liquidity right now. I have the highest cash position I've had in the fund since 2008, when the fund was almost 80% cash. Now it's about 60. I am finding a number of things to do, which is why 40% of the fund is still invested and still making money. I mean, the fund's doing fine. It's doing what it's supposed to do. I'm very excited for when volatility hits for a couple reasons. When it hits, like I said, the first place we look, we basically have a playbook that we follow. First place we look is in the synthetic markets, because people inevitably, you have very panicky hedge fund managers and arbitrage managers who instantly go into these markets and start to do lots of volume trading, and that creates inconsistencies, it creates irregularities, much more so in that market than it does in the cash markets. Eventually it makes its way to the cash markets, but every time vol hits, we first go to the synthetic markets. Things like, for instance, default tranches, which are just very, very simple ways to project the risk of default in a basket of securities over time. These things get completely mispriced, and people start to build in outrageous default rates into these things when vol hits or risk comes off. So that's the first place we typically start. We then look at individual credit default swaps and what we call correlation trades. Then we'll move into the cash markets if the risk keeps coming off. That's when we'll start to build back up the positions that we took off at ideally much, much tighter spreads.
So one last question then. We've talked about this before, the fact that, your style in particular, especially when you're this much in cash, it's very much about not having interest rate risk at this stage of the market. We had a lot of questions, obviously, about, does that make sense within the context of a broader portfolio? Do not have to worry about the fact that I don't have rate sensitivity. And you've got a particular outlook on that as an absolute return manager. Maybe tell us that.
Yeah, it's a completely different ballgame when you're an absolute return manager, because you can't lose money for people, right? When I was a long-only manager, I wasn't in charge of that decision. The market was. Rates were. So if you're following a benchmark like the Barclays Aggregate Index, you have very limited ability to control the outcome. Rates go up, you're going to lose money no matter what. With an absolute return fund, you don't have that crutch to lean on. So you have to do things that are consistent with capital preservation when the market's not offering you things to do. You don't want to chase yield when yield's not worth chasing. I always say sometimes the best trading decisions you make as an absolute return manager are the ones you don't. Like you choose not to go into things where the risk of loss is high. So, when I look around this environment right now, and the reason my positioning is so defensive, it really just comes down to, again, what's available in the opportunity set. I would argue that right now the opportunity set is about the most constrained I've ever seen in terms of beta. And frankly, if I weren't doing the things I'm doing right now, that would be inconsistent with absolute return principles. Like if I were sitting here telling you things like, well, Eric, I do understand that high yield is at the tightest levels it's really ever been, but I'm going to add to it now because I think I could squeeze maybe 5-10 bips. Completely inconsistent with absolute return investing. And that's why we choose not to do those things. I will again, like for instance, I don't like interest rates right now. I will like them at some point. And this fund could very well look like a core or core plus bond fund at some point. But it's not going to be until I'm getting paid a sufficient amount to take that type of risk on behalf of my investors. Right now is not the time.
All right. Well, thank you so much for being with us. We really appreciate it.
Thank you. Appreciate it, Eric.